tax strategies being pushed to real estate investors right now that actually sound completely legitimate, but they're putting people directly in the path of an IRS audit. In this video, I'm going to walk you through 3 strategies the IRS is actively flagging right now as part of what they call the Dirty Dozen. Now, these are things they're seeing, going after, and that are getting investors into trouble. And that's where things start to get real. And I'm also going to share one at the end that's not even on the Dirty Dozen list, but it is something the IRS has been aggressively going after in audits. And this is exactly where a lot of investors are caught off guard. Every year, the IRS actually releases something called the Dirty Dozen. And it's a list of tax schemes they're actively seeing and going after. And the reason they put that list out is because people are still falling for them. Because none of these are being marketed as risky. They're being marketed as smart, strategic tax moves. Before we get into this, let me quickly introduce myself. My name is Lisa Marie Odeja, and I'm a CPA and an enrolled agent, and I specialize in tax strategy for real estate investors. Now, earlier in my career, I worked as a federal government auditor. So I approach tax strategy with an understanding of how positions actually hold up under a review. So when I hear strategies like this, I'm not thinking about how they sound. I'm thinking about what happens when they're reviewed. One of the biggest things I'm seeing right now is the tax credits are being pushed as if they automatically apply. Here's how it's usually presented. You're told you qualify for a specific credit and that it's going to reduce your taxes or increase your refund. But what's actually happening is the focus is on the result and not the requirements. And when the IRS looks at this later, they're not looking at what you were told. They're looking at whether you actually qualified. And if you didn't, those credits get disallowed, which means you're paying tax back, plus penalties, plus interest. And what usually isn't being discussed is what actually has to be in place for it to hold up. How it needs to be documented, and what actually makes you eligible and what needs to be there to support it. Another one I'm seeing is donation strategies, where something is purchased and then assigned a much higher value for a deduction. So you buy something at one price, have it appraised for a significantly greater amount, and then claim a higher amount. On paper, it sounds like a smart move, right? But when that gets looked at later, they don't just accept the number. They look at how the value was determined. And if that doesn't hold up, that deduction gets reduced or removed, which means you're now paying tax on something you thought was already handled. So a third thing I'm seeing is personal expenses being written off as business deductions. And this is usually framed as, you can write this off, you can deduct that, as long as it's tied to your business. But when the IRS looks at this, they're not looking at how it was described to you. They're looking at whether it actually qualifies as an ordinary and necessary business expense. And if it doesn't, those deductions get disallowed, which means you're now paying tax on income you thought had already been reduced. And this is where people get into trouble because the line between personal and business was never clearly defined in the first place. Now I told you I'd share one more. This one isn't even on the dirty dozen list, but it is something the IRS has been aggressively going after in audits, and that's the conservation easements. At the basic level, a conservation easement is a legal agreement that limits how land can be used in exchange for a potential tax deduction. And in the right situation, this can be completely legitimate. But what I'm seeing more of are deals being structured where investors come in and are promised large charitable deductions in return, sometimes even significantly larger than the amount they actually invested. And that's where the scrutiny starts. Because when the IRS looks at these, they're not just looking at the deduction. They're looking at how the property was valued, how the deduction was calculated, and whether the entire structure actually holds up. And this is where a lot of these fall apart. Because if that valuation doesn't hold, that deduction can be reduced or completely disallowed, which means you're now paying tax on income you thought had already been offset, plus penalties, plus interest. So what makes this difficult is that none of these sound unreasonable when you hear them. That's actually why people move forward with them. And by the time questions start coming up, the decision has already been made. I don't approach this the way these strategies are being presented. When someone comes to me, the first thing I'm looking at isn't, can we take this? It's, does this actually make sense for you? We're looking at your full situation, your income, your structure, and whether this would actually hold up if it were ever questioned. Because this isn't just about creating tax results. It's about making sure you're protected after the fact. And from my background, I know what this looks like on the other side. I know what gets looked at and what has to be there to support it. I'm not going to let you walk into something that creates a bigger problem later. And right now, with the filing deadlines right around the corner, this is when these decisions become real. Because once it's filed, the decision is locked in. If you are a real estate investor and you're not completely confident in what's on your return, or what you've been told to do, this is not something you want to guess on. This is exactly what I help with. You can schedule a consultation using the link below. If you found this video helpful, like the video, leave a comment, and share it with another real estate investor. And subscribe so you don't miss future videos where I break down real estate tax strategies that actually works. Thanks for watching, and I'll see you in the next video.